Hey, what's up, everybody? I want to clear up a question that I get asked all the time from my clients, and that is what in the world is an APR and what's the difference between that and my interest rate? And this is one of those things that it sounds really simple, but I promise you it can trip people up really easy. So let's break it down in a way that makes sense and leaves you feeling like a mortgage pro by the end of this video. So, first off, let's talk about the difference between an earned and an unearned finance charge. Now, your interest rate, along with the loan amount and the term, determine the daily rate of interest or your earned finance charge. Now, the government also says that any fee that you have to pay because you're buying your house with a loan that you wouldn't pay if you paid cash for your house, that is actually what's considered an unearned finance charge. And both of them are finance charges that you're likely going to have on your mortgage loan. All right, so let's start with the actual interest rate. I want you to think of the interest rate as the earned finance charge or cost that you're paying each year for borrowing the money to buy your home. Now, if you're getting a 6% interest rate on a loan, that's what you're paying on the loan amount alone. Pretty simple, right? That's the interest just on your loan amount. Now, the APR or the annual percentage rate, it's actually a little bit different. This actually includes the interest rate or the earned finance charge and other loan related cost or unearned finance charges. I like to think of the APR as kind of an all in rate that factors in fees like closing costs, origination fees, maybe mortgage insurance or lender's title insurance premium, a few other odds and ends as well. Now, the APR is going to give you a more complete picture of what the loan costs are over time, not just the percentage rate that you're paying on the loan amount. So let's say that you're looking at two different loans, and both of these loans have the exact same interest rate of 6%, but one of them has higher costs. The loan that has the higher cost is actually going to have a higher APR than the other one. It's telling you that. So even if they're similar, you're actually paying more for one of those loans over the long haul than you are the other. Pretty simple, right? So, to keep things straight, the interest rate tells you what you're paying on the money borrowed, while the APR is the interest plus additional cost, giving you the total overall picture. Now, I'll let you in on something that a lot of people really do overlook. Just because one loan has a lower interest rate, that does not mean it's the best deal. Always, always, always compare the APRs because if one lender is offering you 6% interest with an APR of 6.25 and another lender is offering you 5.9% interest, that's a better rate, right? But if they have an APR of 6.5, that first loan might actually be the better deal in the long run, even though it's got a little bit of a higher interest rate. The APR actually helps you see all the real and total costs of your loan, not just the interest rate. So just remember, it's really, really important to look at both numbers. So if you're ever in doubt or you just want a second opinion, reach out today and I'll be glad to explain it honestly and help you pick the loan that's truly what's best for you. Or if you are looking for a second opinion for sure, feel free to text me or email your loan estimate and we'll give you an honest assessment. Now, hey, thanks for hanging in there with me today. I hope that you found this helpful. And if you did, please go ahead and hit that like button and maybe even subscribe if you would for more tips on navigating the mortgage world with confidence. And remember, the right loan should make you feel excited to step into your new home, not stressed out about the numbers. My team and I are here to help you make that happen in any way that we can. So reach out by phone, text, or email, and we hope to talk to you soon.